there's the parent price swing that's currently being traded in right there. Okay, so this movement here, when price gets down to equilibrium, we would study and see if there's a reason to be a buyer. There's an order block over here, so there may be something to look at on the lower time frame. Maybe there was a loss. Maybe you didn't take a trade. I don't know. But price goes down into a deeper discount, trades right into bullish order block. Price hits it. Does it spend much time there? No, it rallies aggressively. And it fills in an area where price had already moved in rather quickly. And I'll just toss this in there for teasing purposes. It goes right up to the bottom of this bullish candle, which is a bearish order block. And that's an area where you would look to take profits on a long position. If you did something like that, buying, say you bought it maybe here in the middle of this range here, and you got out there, that's 175 pips. Factoring in spread by 170 pips. How can anyone be upset with something like that? When you're waiting around, you're not getting a million trades, okay? There's not a lot of, this is the daily chart. So you're getting about one per week, really good high odds opportunities. So when you see moves like this, okay, you can see there's a willingness to recapitalize these levels based on the fact that the market goes to a discount. We have the same price swing back here. You always use the same ranges that we're currently in. This range is still in effect. Market comes back down into the 79% chasing level, which is still a deep discount market. And also, it blows out an old low. So there may be some stops down here that the market takes out. Now think, if the market's going to go higher, generally, if the market's going to go higher and it's bullish and it comes down below an old low, that's generally going to be a stop loss run. That was the first thing I taught in 2010, to look for dynamic price moves. If you understand what a bullish market is, okay, you want to define every time the market creates a low and then violates that low. If it does that, generally that means that the market makers or the institutional banking algo will go down below the lows and gather up any orders that will be resting below those orders. Below that low. This low here, it's violated here, immediately rejects and goes higher. This low here, it goes below it here, rejects immediately and goes higher. This low here, it goes down below it, rejects, immediately goes higher. So now think about what I've just given you. I've given you framework to map out what equilibrium is. Okay, what is that? And then I told you what the benefit of knowing what below equilibrium is. It's discount. So when you're looking for a market, when you're looking at a range in the marketplace and the market goes below an old low, that gives you context to look for what? Stop rates below the lows, and there should be a reaction going higher. If the market's bullish, if the market's underlying tone is bullish, and we're going to frame all that stuff, but for now I want you to study, go in your charts, and you'll see a plethora of these things occurring all the time. And it gives you the building blocks of knowing what trading setups form, how the market should react, and you'll start seeing these things before they happen. You want to study them in the past first, but then start looking for them to anticipate future moves based on what I'm teaching you here. So in summary, we understand that equilibrium is the midway point of a range. We need an impulsive price leg higher. Once we identify that an individual impulse price swing, we run our Fibonacci from the low up to the high, and then we wait for 4 candles. Once this 4th candle is lower than the highest one, we start waiting for price to come down into equilibrium. When it does that, we can go in and hunt for buying opportunities on the lower time frames. We blend in institutional order flow ideas like the order blocks, mitigation blocks, breakers, turtle soups,